Everyone, good afternoon. Hope everyone's good. Afternoon, guys. Afternoon, everyone. Hope everyone's fine. Good health. Low attendance today. Okay. So, guys, last class we had done this, right? We had done VAT. Do you remember the formula for VAT now? You need to remember what is the formula for VAT? It is average cost of capital. No? Why do you want to remember the formula for VAT? Is it there a formula? Is there a formula for VAT? Alright, it is like just cost of capital and you require weights. That's it. How can you find weights by debt to equity? If I give you debt to equity of let's say 0.75, what should be my weights? That is debt to equity. What will be my weights? How to find? Manish, so that in current assets and current liability, you need to know which activity was this. If you know which activity is it, whether it is investing, operating, or financing. In current assets, they have schedules, so you have to look at the schedules in that, which is that specific activity. And then you have to identify whether it was operations, whether it was required on day-to-day basis, whether it was a financing, or whether they had invested in somewhere. Yeah, right, 75 by, yeah, okay. Fine, so this is how you get, this is the only, in interviews you get this thing only, they give you a P&L and balance sheet. They tell you to forecast, and after forecasting, they tell you to, make this, and at the end, find the enterprise value. Now over here, now we had found the enterprise value, right? What is this? The value of the cash flows that the company will earn in future years, right? And this was a terminal value. Terminal value is what? Value of all the cash flows that the company will earn in the years to come. Okay. This was, I think this was easy, right? Till here we had done, and I just told you the formula for terminal value. What is the formula for terminal value? Anyone tell me? The formula for terminal value? This was the only thing that you need to remember. Okay, FCF in the year 5 into 1 plus G, right? Divide by WACC minus growth. This was the only formula that you need to remember for terminal value. Once you know this, everything. Now what you do is just take the total cash flows, add everything, and then discount it. You will get your value. Now, what is this enterprise value? This cash flows is free cash flow to firm. Was the cash flow before paying the firm or after paying? Sorry, before paying to debt holders or after paying the debt holders? You come up with a value saying that the value of your company is 46,000. When I say the value of the company is 46, the enterprise value over here means you have, it is the value towards debt and equity holder. Because this is the cash which is available before paying interest. We have added interest over here. This is the cash before paying the interest. This cash flow belongs to whom? All the value. And I said it belongs to the debt holder as well. Now, what does it mean here? Assets. Okay. You have liabilities, you have assets. Now, in accounting, what we have said, like I said, this is equity. Okay. Example, equity is 100, no? Debt is 100, the debt is 200, fixed, let's say all assets are 300. So this should tally, so this and this. Now, what is the value of the company now? How we find the value of the company? Means what does it mean? Today, if you want to buy the company, can I say you will buy all the assets? Forget that value of the company. What is it? It is called, when you buy a company, can I say you buy all the assets? Let us say I have a car which is of 10 lakhs and I have a 3 lakh rupees loan on it. So now, if you want to buy my car, okay. So what should be its value? I have a 10 lakh rupees car, the market value is 10 lakh and I have a 3 lakh rupees loan on it. How much amount will you pay to me? How much amount will you pay to me? Manali says 10. What about you? I have a car which is 10 lakh, okay, which is 10 lakhs. Practical example, I have 10 lakh rupees car. A 1 million rupees car and I have a loan on it at 300. So if you want to buy my car, you will pay me 10 lakhs. Why? Will you pay me 10 lakhs? Others? Others are not replying. Harita, Rishabh, Nishant. How much price will you pay me? I have a car which is 3 lakh and which has a loan of, so I have a car which is 10 lakh which has a loan of 3 lakh. What price will you pay me? See, you cannot pay me 10 lakh because if you pay me 10 lakhs, 3 lakh you have to pay the loan. If you take a car which is of loan and you transfer the ownership, now what, the car becomes yours. Now you are the owner, so you have to pay the debt. No, I am not paying the debt. I was saying that I have a loan of 3 lakh. It will not pay me 10 lakh. Even the price of the value is 10 lakh. Yeah, forget about depreciation. See, take practical example now. That's why I don't use all those words to confuse. Now this is what to remember practically. If you have a car which is 10 lakh and a 3 lakh rupees loan, obviously you will not pay me 10 lakh rupees. Because so if this is my assets, so this is how it works. If this is my assets and this is my debt, so what is my equity value? Equity value means the value of the company is 7 lakhs. It is not 10 lakhs because these assets are purchased on debt. Tomorrow, if you want to buy my company, you also have to pay off the debt. So guys, ideally, what was the cost that you had for the car? When you transfer the asset, let's say when I give you the car, I'll go back again. When I give you the car, now obviously you paid me 7 lakh rupees. Now loan belongs to you. Am I right? The loan belongs to you. Yeah, because I have transferred the ownership, right? See, you know that the market value of the car was 10 lakhs. And you also know that there was a loan of 3 lakh on it. That is why you paid me 7 lakh because you know that you have to pay the 3 lakh. Yeah, it is just terminology which changes. Asset changes to car, changes to an asset, and loan changes to debt. So guys, think practical. This finance is all practical just because of the words, the enterprise value, market value of equity, market value of debt, intrinsic value. That is why the finance is difficult. Now, this everyone can understand. This is again logic. If you understand profit and loss, obviously you will not buy a car of 10 lakh, which has a loan of 3 lakh. Will you go and buy? Even if you buy, will you pay him 10 lakh rupees? Will you guys pay me 10 lakh rupees? I will transfer the ownership to you. Now the loan belongs to you. It is actually like that. Practical life. You take a car, that is why whenever you purchase a second-hand car, you have to always ask that whether the car is on loan or not. Because tomorrow, if the car becomes on your name, you have to pay the debt. Okay. And if you know that, you have to pay a debt of 3 lakh. So obviously you will not pay me 7 lakhs. So you will not pay me 10 lakhs. You will only pay me 7 lakhs. Am I right? What is this enterprise value means? Enterprise value means you are buying the whole of my assets. Whole of my assets and my liabilities all belongs to you now. The asset also belongs to you. The liability also belongs to me. If this is the value, or let us say, in this example, what is my enterprise value? Means the value of the full company. I am buying the full company. Yeah, asset minus liability will be the value that you give to the equity shareholders, right? In this example, enterprise means you purchase all the assets. And I'm saying value of purchasing an asset. That means enterprise value. So ideally, can I say you in this example, you should have shell out 300 rupees. Achha, 1 second. Before going that, in this example, tell me, let us say you paid me 7 lakh rupees for the car. Okay. Now, ideally, how much was the car cost to you? What is the price of the car that cost you? So you paid me 7 lakhs. Now this 3 lakh belongs to you. So ideally this car cost you how much? 10 lakhs. 1 lakh, right? Now this value was inclusive of, what is it? The car value, equity. And this is the equity. And this is debt. Right now? This is equity, this is debt. Am I right? The total cost that you took a car for 7 lakhs and you also get a loan on it, because that car was at loan. So when I transfer the ownership to you, this loan belongs to you. So ideally the cost of the car becomes 10 lakhs. So ideally how much you sell out is 10 lakhs. And here the loan also you have also paid off to the debt holders. And here the enterprise value over here means, enterprise value means what? Equity and debt. What does it mean? That to buy the company, you means buy the asset of the company, you have to pay how much? 46,000 rupees. Now to buy the whole company, when you are an investor, are you interested in buying the whole company? Means do you want to buy the whole company and then start running the company? This was the value of, means what? Enterprise value means what? You pay off to the debt holders and to the equity holders. It means that that you also pay to the equity holders and you also pay to the debtors, because this is the cash flow that we have found. It is before paying the interest. Okay, so here you have not paid off your debt holders. So whatever value the company holds is the value that belongs to the equity and the debt holders. Now, if I ask you that you only want to find the value of equity, how will you find? Means I say that the enterprise value is a mixture of debt and equity. Now, obviously, I'm not interested in getting it because I'm not interested in buying the company. I'm just interested in owning a part of the company. If I say the enterprise value belongs to equity and debt, and I want to find the equity value, what should I do? And can you get the market value of debt? Can you get the market value of debt? Can you get a market value of debt? Where? Where will I get it? But so today, because we are discounting it, so today's price, where will I get it? Not the rate, Prasanna. I'm asking on the market debt. How much debt you have? Where do we get it? Where will I get the debt amount? Yeah, from the balance sheet, right? And balance sheet of which year? FY22 or not 23, because this is what we have forecasted. We'll only talk about 22. So here the debt and long term, okay, not short term, because short term debt are usually paid off. Okay, so we just take about the long term debt. Your equity value will be, can I say, this minus this. For equity value is okay. Now I ask you one thing. When you purchase this car, okay, from me, there's a when I send you the car, when I gave you the car, in that car there was 50,000 rupees, or let's say 1 lakh rupees in cash. Okay, in that car, 1 lakh rupees was cash. Now this cash belongs to whom? I'm not saying that it was by mistakenly. I'm saying there was there only. With that both value, the value was 10 lakhs. Now the cash belongs to the buyer. Now you tell me, eventually, how much did he sell out? Eventually, how much did he sell out then? He paid equity holders 7 lakh. He paid debt holders 3 lakh. But when he paid equity holders 7 lakh, what he got? What he got in return? 1 lakh rupees. You tell me, what is the cost of the car for you? Practical example, just don't use finance in that. Oh, 19. The total cost of the car was 10 lakh. From that 10 lakh, you paid 7 lakh the equivalent and 3 lakh the. Now I'm asking that if the cost of the car was 10 lakh, so you bought the car, right? So when how did you bought the car? You paid 10 lakh rupees to buy the car, which what equity value was 7 lakh and the debt value was 3 lakh. And I say when you buy this equity car, there was 1 lakh rupees cash in that car. So ideally, how much did you sell out? Right, 9 lakhs. Right, ideally 9 lakh, no? Because 10 lakhs you paid and you found out that in the car there was 1 lakh rupees. That belongs to you. So ideally you only paid 9 lakhs. This amount is usually said to be, it's just calculated as this. Equity value. What is enterprise value? There are two types. When you are finding enterprise value from DCF, it is the sum of all the parts. Okay. Now, if you want to find enterprise value from the market, so how you find is equity value plus debt less cash. Can I say this? Your enterprise value is what? These are two things. Huh? First is enterprise first. Okay. First is enterprise value is found by discounting FCFF. Okay. This is the first part of enterprise value. Now, if you want to find enterprise value of the company today, see, this is what we have estimated. Okay. Now, if you want to find the company's value today, how do you find? See, when you want to buy a company, what all things you do? You pay off to the equity holders, right? You pay. So what if you want to buy the car? You pay off to the equity holders and you pay off to the loan debt holders. So 10 lakhs you ideally pay. Now in that 10 lakh you found that 1 lakh was rupees cash. So what do you do in the formula? How do I put the not formula? Then how will you put it? You pay to the equity value. Equity holders how much? 7 lakhs you pay to the equity holders. Debt holders how much you paid? 3 lakhs. Less cash. This is what you received. Now 1 lakh. So ideally how much you paid? 7 plus 3 minus 9 lakh is what you paid. Right now? Am I right? 9 lakh is what you paid. This is how this enterprise value works. So in this, what are the things we have? Now this is enterprise value is what is summation of all this. Okay. Now in this debt we have, debt we already know. Okay, from the balance sheet. 2022 balance sheet it was 56. Cash we have. Cash also same. What is the cash that we have? The balance sheet it was 181. What will be my equity value now? Yeah, entire portion of source of see equity enterprise value is what? Buying your assets. Buying all of your assets. So when you buy your assets, what you have? You pay the equity holders and then the debt holders. Enterprise is nothing but value of the whole company. So how we define as whole company buying the assets? Buying the assets is said to be buying your equity and buying your debt. Means paying off your equity holders and paying off your debt holders. Okay. So how will you find? Here we have to find usually only long term debt is taken because short term debt now what happens, it has been paid off at a time. So ideally I will prefer to take long term only because that is the that is when you talk about companies because we are talking about a future value. Okay, the short term is that you pay off with current liabilities are paid with current assets usually. Every time a current liability is always there with current assets. That is usually paid off. So when we talk about enterprise value, I will rather prefer in formulas they say that you have to take both the debt, long term and short term. But practically, I will suggest only long term is what you take. Now here, if this is the equation, what is the second enterprise value? Second way of enterprise value is second formula for enterprise value is enterprise value is equal to, can I say equity value, that is market value of equity value of equity, market value of debt less cash. Now how do you find equity value if you have the enterprise value? The first you found by this. Okay, this is what you found. Second, you have to what we do with this. We are not interested in the enterprise value because we are not interested in running the company. We are interested in knowing the equity value. Now, how to find equity value in this equation? Can you find the equity value? Can you find? Anyone? What is the enterprise value? Where is the price? Manish, where is the price? That today what you do is if today you want to buy the company, this is what you have to pay. Okay, to buy the whole company. I have to say, what do you pay to the equity holders? Manish, if you know the average price of the company, then why have you made a model? Guys, model, there are two things, okay? One is enterprise value that we find, and one is the market value that is already there in the market. We have to find is that value correct. So according to us, what is the value? So according to us, this is the value. Enterprise value is the value of all the equity and debt holders. Now here I have to only find the value for equity and debt holders. How to find? This is the amount I found. Enterprise value I found. I have market value of debt. I have cash. How will you find equity value? Your enterprise value minus debt plus cash. This will be your enterprise value, equity value. you assume that the total value of the company means if you want to buy the company today, how much you have to pay the equity holders and the debt holders is combined, you have to pay 46 to 46. This is the combined amount that you have to pay. So out of that, how much you should pay to equity holders? That is what we have to find. We have to subtract debt, but we cannot just subtract debt. We have to, minus the cash as well, because cash belongs to whom? When you purchase the car, did the cash belong to the debt holders or the equity holders? You purchase my car. Did you pay the 1 lakh rupees cash to debt holders? Cash belongs to the equity holders. So what, it should increase or decrease the value of the equity? According to you, what is the increase, no? But the cash belongs to you, right? The value should increase. This is how the enterprise value is. Now, what is that? Now, if you have number of shares with you, this is what, we have found the market value, okay? This is what we have found out. This is not the market value that it is there in the market. This is the market value. According to our analysis, the market value of the company should be 46,390. That is the full value of the company. That is also called market cap. If you know, it is also called market capitalization. Market means market capitalization, again an English word. The total market of the company. Total price of the company. Equity value is also called the market value and the market capitalization. This is what we have found by doing all this analysis. Right? This is the market value of the full company. Can you find per share market value? Can you find value per share? Because in the stock market, values are given by per share values. It is not given full. So, and value per share is also called intrinsic value. Yeah, equity value. Number of shares is given over here. We have calculated number of shares. Yeah, value per share will be equity value divided by the number of shares. Is 2321. Now we have to compare this with our stock market value. Can anyone tell me what is the value for Hero MotoCorp? What is the value for Hero MotoCorp? Anyone? Yeah, current price is market price, okay, 2751. So current price is 2751, and now upside or downside means what is it? According to you, the value of the company should be 2321, but in the market the value is 2751. Should you buy or sell? You should sell this down. So there's a downside of 15.6%. Yeah, we should short, right? But according to us, the value should be 2321, but now value is 2751. Got it? This is how the enterprise value. Now, what is the enterprise value? Enterprise value is nothing but what you pay to the debt and the equity holders. Okay. And always remember, if you have cash, it will increase your value because you have the cash with you. It will not decrease your value. So you get the cash, right? This value is two methods. Okay. First is it is found by discounting the free cash flows. Second, it is enterprise value. If I ask you today, let us say today, Hero MotoCorp price was 2751. Okay, that you said. Now from the balance sheet, if I ask you, this is the latest balance sheet. What is the enterprise value? How will you find? How will you find? If today you want to buy this company, if today you want to buy this company, how much? How will you value it? Total equity plus total debt and minus cash also. Okay. Now today, now this is the value of the company. Okay, now you have to pay off, right, to buy the company. So whom do you pay off? Today you buy the company. Can I say you give value to the equity holders, you give money to equity holders and give money to debt holders. That is your total market value. Now here in our over here, let us take the whole of the liabilities. Okay, over here. Total liabilities is this much. Okay. Example 2248 is you pay to the debt and the equity holders. Yeah, ideally it should be long and short term, because today if you want to buy, all the liabilities also belongs to you. Means you also, this also you have to pay. It's actually the total debt plus total equity. But since we take it long term, now I only prefer about, because short term debt keeps on changing year on year. But now let's practical example. So if exam is asked, if interview is asked, it is all okay. Total debt. Okay, total debt, total equity. So today if you want to buy this company, obviously you have to pay your debt holders and the equity holders. So what is it? Total debt and equity is 24,700. But now, will you pay the equity holder as per the book value or the market value? Market value, right? So what was the market value of Hero MotoCorp? It was something 2751, right? And we had 2751. And then what it had, number of shares were almost 19.98, right? This is the market value. So total, you should pay how much? 54,000 plus this. No, total. Now this and this. So now when you pay this, how much will you get something back? So now all your asset value belongs to you. So you will get cash back, because if the cash is there in the company, obviously you will get the cash back. So eventually you will not pay this much. Or first is your market value. Then market value of equity. Okay. Was over here. All right. 54,000. As I said, total value of all the debt. Okay. Total value of debt. Is what? Let us check all the debt. That is your current liabilities and your non-current liabilities. Okay, this is the debt that you have. You have to pay off all this, right? And when you get this, I say that less cash. So what is your cash over here? Yes. So eventually, how much you will pay out? Okay, eventually you will pay out 61,000 today. Today, the enterprise value today is 61,000. See, this is today, and this is what we have estimated. Okay, this is today, and this is what we have estimated. Two different things. This is the value of the company today. If today you want to buy, means is this value right or wrong? That you have to determine by doing the analysis. Yeah, I was coming on this. Why it is overvalued. Okay, now this is how it is found. Okay, this is the current value. Now you have to find whether this value is right or wrong, whether you should pay this value. So according to us, what was it? According to us, it was 46,000. So obviously you should sell it in this one, 46,000. We are not interested in enterprise value. We are interested in the equity value. Okay. Now, Musba has asked one question that most of the company in Indian, see when you do DCF now, many of the Indian companies you will find it is overvalued. There is a reason for it. It is not wrong, or it is not that you have to sell it. Most of the company you will find it overvalued. No, markets are not, see, markets are not efficient everywhere. Everywhere there is a scope of, making profits. Any market. So inefficient, so it can also be undervalued. Now, why is only overvalued? The reason is now there's again a practical reason to it. There's no, this reason is not given in any books. See, it is actually the fair value of the company. Intrinsic value is what we assume that if the company is earning this much of cash in the years to come, this should be the value. That is fair enough. But practically, let us say you have a salary of 1 crore today. Okay. Let us say you earn 1 crore today. You earning 1 crore today and Mukesh Ambani earning 1 crore. Okay. Who will make the money grow? You or Mukesh Ambani? You are a fresh, let's say you just got a, let's say you are an IIT graduate, I am graduate, you got 1 crore rupees package. You earning 1 crore, means in your bank, you having 1 crore and Mukesh Ambani having 1 crore, which makes a lot of difference. Who will you bet on? Right, Mukesh Ambani, because you know that what you can do is you can just go and spend somewhere out. Okay. You don't know how to grow it. Mukesh Ambani has told, he has shown how it is grown, how the money is growing. So now you just cannot value those companies just on based on the cash flow. What are you saying over here is that if the company is earning this 46,000 cash this much cash, what we got is total cash. We got this, the total cash flows. What was it? 82,000. Means you are saying that if the company has earned 82,000 crores in the next 5 years, in the years to come, you just discount it to present value. This is usually said to be an cost of capital, inflation rate rather. Does your value of your money only remains this much? If tomorrow, if Mukesh Ambani earns 82,000 crores, can you just say that 82,000 crores divided by the inflation rate to the present value is this much, 46,000? See, he can make billions out of it. Okay, if you have money with that. So this, this all DCF is only used for companies which are not known or mid-cap companies, which doesn't have a brand name, where you cannot know, where you don't know whether the company, where we don't know the capacity of a person. How many entrepreneurs do you know in India? Which are, listed companies, entrepreneurs? Handful of it. What is the name? What all names comes? Adani, Ambani, Tata, Godrej, Birla. That's it. 5 to 10 names, maybe more 10 names. What about other companies? Are they not big? Are they not big? They are, right? And what about the companies which are, very small? Let us say, very small scale business. See, those companies are only valued at DCF because that time you don't know the brand value. You don't know brand value of a company. If tomorrow Mukesh Ambani comes and asks you 1 crore, let's say 1 lakh rupees, and some random guy comes and asks you 1 lakh rupees. Why? Because he's saying that I will grow my business. Whom will you give? Why? Why only to Ambani? Why not to the other? Brand, trust, goodwill, and he has shown in the past that he can do things like that. He can grow your money faster. That is the why people invest. So if you want to invest, so that is the reason you just cannot discount this cash flows directly to it just by the inflation rate. There's much more to this cash. That is why majority of the companies in India, bigger companies, you will find the companies are overvalued. DCF will not work. Okay. But for smaller companies, obviously DCF is the most important method to, to find the value of a company, irrespective of the company. Here, if I give you dummy numbers, you don't know the company, you don't know who people are. That time, you can take this answer. You can take this. So mid cap companies, small cap companies use DCF, not the large cap companies. Apple, you do DCF for Apple, you will always find it is undervalued. It is overvalued. Always. And still Apple will grow. TCS, you do TCS, Always it will be overvalued. TCS overvalued, Infosys overvalued. You can never do DCF on such companies. What you can do is, when you cannot do, there is another method that is called the market multiple approach. That is the method which is used. The P ratios and all. Okay, so ideally what happens now, this is because every company is not large cap companies. Maybe 10 to 15 or maybe 20% of the companies are large cap, whether 80% of the companies are small cap or mid cap. So DCF is used all across industries. Now this is the only thing that you need to know to clear interviews. If you can make this model, 5-7 models of this, 5 to 7 companies, and then make a ratio analysis of it, you can be a better place to go in an interview, or else at least get selected for an interview process. I have seen students asking, sir, I'm passionate about equity, I'm passionate about this, give me a chance, etc., etc., etc. I will work hard. Till now, what have you done? See, when I say that I have a passion to play cricket, okay, example, if you want to hire a driver only, if you don't know his past history, will you hire him for your car? Let us say you have a Merc with you. One guy suddenly comes and say that, sir, I am very passionate about driving cars. I love cars. I have seen cars on the road. Give me a chance. I will drive better. Will you even give him a chance to sit in your car? No, just looking at Virat Kohli play, says I am very passionate about cricket. I might make it to the Indian team. I watch cricket every day. I watch people play. I'm active on social media. I know what Virat Kohli eats. Will that help to be a good cricketer? So here you have to practice on your own. If you're not getting internship opportunities, do it on your own. This is what we have taught. So we are all doing it for we are not doing it for money. As if you have seen, it's very hardly. If you go to classes, they are charging you 50,000 for financial modeling. It's more than your CFA fees nowadays. We are hardly charging anything. That too, you are there for 2-3 months. That classes are done in 45 days. If you don't put efforts in that, you are not getting a job. Or else, if you are so much talented, crack an IIM job, crack an IIM, clear CFA level 3, clear CA, if you have that talented. If you're not, you have to learn all these things, and not one will not be enough. Again, I've seen people posting on LinkedIn, I've made this model. Now what? Okay. Now what? What about other models? What did you analyze from the model? There is no part of it. No one has ever given a written note that why I like this company. It's just that I have made a model, I have given DCF, I have assumed this, I have assumed that, random assumptions, and fine, I've done a model. Now, with this model, at least try making this model. So I and Samitra are working on something that we will start an internship where students who are interested can work with me along. I have a portfolio where I need to need students or need people to track my stocks. What is happening? I have models that you need to update. Those are things will help. You can search out for internship also in other companies. If you are working on that model, will come up and will let you know. But for that, first of all, for internship, I will require you guys to know this. If you don't know this, you will all delink my model, and then I will only scratch my head that where is this numbers coming from? Why are my numbers not telling? So even for getting internship, you require model. You say you know modeling. So I have placed one girl. She knew modeling. She had worked in here only, equivalent research only. She so told me that, sir, I have made 3-4 models. So can you look at it? So models were okay. I told him this were 2-3 mistakes that I found. Then he rectified it. One of my ex-colleagues, told me that, Rishabh, I am finding an intern to work. It was free of cost, but it was with HDFC Securities. He said that he need to come to office and work for us at least for 2-3 months. She was ready to work, and then she got a package. She got a role in HDFC Securities. And that was a huge thing that happened. Even I didn't expect it that she will get into HDFC Securities. They liked their work so much that they hired her. This is how it works, you know. When you give something, you get something from someone else. If you just say no, I will go home, or it is just no, this is just free of cost. You know, so it is hardly a free of cost. 1,000 rupees, nothing today's world. Will not help. Still, you will again put on LinkedIn. I'm not getting jobs, sir. Please refer me. I get many answers, many questions on LinkedIn. Sir, refer me over here, refer me over there. I don't look at the messages also. I just see their profile. If they are not that educated, obviously no one will hire. It's not I do it, it's not I do it purposely, but obviously if I cannot refer them, they don't know anything. Okay. So this was one part. Now here we have left out with, you know, back when we did, I just told you that cost of equity is 15%. See, cost of debt everyone knows. And the cost of debt is just the interest rate that we found out, right? Interest rate that we take on the loan, that is called the cost of debt. Now, what is cost of equity? Do you pay anything to equity holders? We pay dividends, but dividends is not fixed. Huh? See, when you give money to the bank FD, you get a fixed return. Dividends is not that you get. See, when someone comes, you know, startups, do they pay dividends? We don't make profits only, we make dividends. Even big companies, only big companies do. Even mid-cap companies, profit-making companies don't give dividends that much. So now, if I come to you guys, okay, see now, how does it work? This cost of equity. Now, there's a formula you must have known, that CAPM, capital asset pricing model. Many of you must be knowing, yeah, capital asset pricing. What is that actually? What is that cost of equity means? Even with that solving the formula, if you get that answer, what does it mean? Now, let me tell you one thing. Today, I require money for my business. Okay. I went to bank. Okay, bank is giving me at, let's say, 5-7%. Okay, but you know, for bank they require a lot of, they have to keep assets under, you know, they have to, so I have to give them the asset. They will look at my income and all, they will put all those check. Now I come to you, say that this is my, you know, strategy. I will do like this. This is my new product. I will grow and I require money. Now let us say you give me 50 lakhs rupees. Okay, example. What will I give you in return? You tell me. If someone comes here to you saying that I want to invest, please you invest in my company. Will you invest free of cost? It's like you give me 50 lakhs today, after 15-20 years, when I grow big, I will give you a 50 lakhs back. Huh? Does it mean? Yeah, return, yeah. How, that was I'm saying. How does an equity holder get a return? How does it get? Increasing price. But let us say that company is not listed. Where I am listed, I'm starting my new venture tomorrow. It's also called equity holders. Capital appreciation, you know, because it is in the equity stock market. Stock market rises. What about the company which is not listed on stock market? So by increasing the value of the company, okay. How does the value of a company increase? Yeah, say sales, profits. Are they ideally profit, right? Not sales, profits, right? Right, profits. So means, can I say your profit should grow? See, when you invest in FD, why, Ajit, you have a very why question. Why would a profit grow? If you invest in FD, say you invest 1 lakh, Let us say FD is giving 10%. How much will the, so every year? Okay, sorry. Okay. I thought why every time you're asking why. Okay, sorry. So when I say 10% every year, the company will, this will grow at 10% in FD. So after a few years, you might find that the value of the FD is 14,000. When it gets compounding, right? 1,46,000 after 4-5 years. 1, 2, 3, 4 years. After 4 years. And this is what you expect in FD, right? So if I just give you this much, if I give you this numbers, okay, I just give you that, I will earn this much, okay. You don't have this number. I'm saying that this is the cash that you will, or let us say, in the year 4, you will earn this much of cash, right? This is what I'm saying. Now, how much return you want? I mean, if FD is giving 10%, okay, and if I come to you and say that, guys, I am doing, I am estimating that my profit will be 146. Okay, 1 lakh. See, investing 1 lakh. Okay, let me show you. Investing 1 lakh for 4 years gets you 1,46,000. Okay, that is what you know. Okay, now I come to you that, okay, guys, don't you give me 1 lakh rupees. Okay, I'm saying that at the end of 4th year, I will earn 1,50,000. This is what I'm estimating. Okay, so how much returns do you expect on my company? More than 10%? More than FD? Quite obviously, more than FD. So if I say that more than FD, so I say that I will earn 1,50,000. Okay, after which year 5, year 4. Okay, how much should I pay you today? What discount rate will you use? If you are saying that your profit will be 1,50,000 after 5 years, at what price should you discount? Right now, more than 11 or 12. Quite obvious. Because obviously you will require more return. FD is giving you 10%. If I just divide this, what will it be? I say 50 lakh divided by 1 plus, let us say I take 12%. Okay, 12% and divide by 4 years. So you should only pay me 95,000. Am I right? You will not pay me 1 lakh. Means what? Your return should be 12% is what you want. So if you do it by 12% over here, no, 1 plus 12%. At the end, that's the only time you will earn 1,50,000. What was this? Ideally, what was this? 1,50,000. What was it? The future value, but I mean, from a company perspective, what was it? Can I say returns or maybe cash flows? That cost of equity, when you say growth, what should grow? Ideally, what should grow? So someone said profit and sales. What should be the precise answer then? Yeah, I wanted to gain and profit, but that gain and profit is because profits are not same as cash flows. So can I say my cash flows should grow at some point? This should be my cash flows at the end of year 5. Then only I will give you this much money. Now, if you earn 1,50,000, that is a free cash flow, right? If you earn 1,50,000 after 5 years, then only I will give you 95,000. So, got how the analysis is done? How the analysis is done? This is the cash flows that you expect that the company will earn after 5 years, and then you discount it back. Now, discount rate is how much? How much returns you want? Now, that cost of equity is the return that you want on your cash flows. Or can I say it is the opportunity cost? Can also be said as the opportunity cost, means that what I would have invested in an FD rather. No, why would I take a risk? Why would I give you 1 lakh and take a risk and invest in a company which might not grow? Rather, I will be safe that I know I will get this company. So that cost of equity is up and above the cost required to put in an FD. So up and above the cost of the FD. Now that CAPM, let's come to that CAPM model. What does that say? I said an FD. Now I said equity over here, but my was a private company, right? Indian stock market, Nifty, has given an approx 12% return in the last 20-25 years. Nifty, huh? And now tell me, is Nifty safe or my company safe? Nifty. Now how much return will you expect? Quite obvious, more than 12, right? Obviously more than 12. Or at least yeah, more than 12, but obviously not less than 12 because Nifty is only giving 12%. Now, how much more that we will calculate? Okay, 15 or 17 or 20, that we will calculate. Now, that will depend on what? You tell me. Yes, tell me. That will depend on what? More than 15, but we have to get a range. Now, that range will depend on what? The riskiness means what? See, never say some kind of risk. If you say something systematic risk, all those risks, now the interviewer will ask you, what do you mean by systematic risk? What do you mean by unsystematic risk? Now will say which can be diversified. If you give such answers in the interview, now he will just reject you. What do you mean by risk? When does a company have a risk? Volatility in what? Elaborate operating risk. I cannot pay the dues. So can I say less profits? See, keep it simple. Keep it as simple as you can. If I tell you that how much percent to invest, sorry, what is the risk of the company? If you want to invest in 2 companies, guys, once again, if you want to invest in an FD, example, ICICI Bank is giving a return of 6%, means FD return. Some small bank, scheduled bank, you don't know also the name of that, giving you 9% return. Which bank will you invest? Now everyone says ICICI. Why is ICICI? Why not scheduled bank? Trusted and safe. Can I say at this time, if you talk in numbers, good profits, good growth. And that's what I'm asking. Why ICICI Bank is good? Why will you invest in FD in ICICI? Why not in a scheduled bank? Now, how you started answering? Just because no risk, volatility, risk tolerance. What is this? See, always think about you investing your money. You are only confused that what do you mean by risk? What is the risk the scheduled bank has compared to ICICI Bank? Just talk in numbers. Even if you don't have the numbers with you, can I say that ICICI Bank will be having a strong profit margin, strong cash flows, good customer base, good products rather. If you don't talk about a company, good products, zero debt or less debt. These are the things which led to increase or decrease in the cost. Diversification of different products. Yeah, all those things come. Just be more practical. Don't get into that finance, whatever you have learned. It is okay that you have learned, but don't just mix it with practical life. That is the reason you guys get rejected in interviews. Because you said say all those things where you don't understand only what are you saying. Risk, volatility. A private, I'm just telling you, private company, my company, what is the risk? What do you mean by volatility? Go ask your father, what do you mean by volatility? Anyone who is doing business or any friend of your father, friend's father is doing business, go and ask them, uncle, what is the volatility of your business? What will he understand? Huh? Go and ask a businessman. Go and ask a Shiv Puri wala or a Pani Puri wala. What is your risk? What is the risk of two Pani Puri walas? Huh? There are two Pani Puri chart pillars. Besides, whom will you invest? So tell me which there's a chart corner 1, chart corner 2. Whom will you give money? What are the reasons? How will one chart guy different from the other chart guy? Good taste. Okay, good customer base. Okay. Then how do you define you? Everyone can define this. Everyone, every individual, even your small brother or sister, he can identify which Sev Puri or Pani Puri wala is good than the other one. How we define? Now you are saying good taste, good customer, hygiene. Then taste, price, right? Taste is now it gives more option. Yeah, if with chat, if he gives even sandwiches, then this basic thing you do it. But when I just when it comes to finance, talk about our volatility, risk. No, then systematic risk. Then someone with a systematic risk, CAPM model. Those basic thing over here. Yeah, also the behavior of Pani Puri wala, right? These are all financial things. Behavior of Pani Puri, you can, if you want to talk in finance language, it is how good is that the brand name of a company, or maybe the person who is running the company, whether he is good or whether he is a cheater. Yeah, management. That's what. Is the management good or not? All small things you analyze. Now everyone answered. Now why didn't you say risk of volatility is more than one guy who is selling chart in one corner, the other one is selling in another corner, so his volatility is high. Huh? I don't understand. Yeah. So that's all thing. That is all, in the finance also. Business is a business. Whether you run a tea shop or whether you run an TCS. It's all business is a business. How you grow, that is important. Now let us say what all things you said. Good taste. Okay. Example, good taste. Then what you said, okay, more products. Okay. Then let us say what all things you said. Good products, more taste. Okay. Character. Okay. Price. Okay. So like a price will keep simple because two guys cannot give two different prices at the same point. So obviously there might be a problem. Quality, you can say quality. Your hygiene, you said someone said hygiene. Girls preferably say hygiene. Boys don't care about this thing. If this is good in this company, who will which company will you invest? Both are selling charts. Let us even taste, we say that okay, taste is more or less same. But you like the one. Go and ask 10 people around you. Which company, I mean, which chart guy gives you a good taste. So obviously this is what you do analysis for a Sev Puri wala, but when you put your own money, you don't do this analysis. You go and invest in some oil companies, some pharma companies where you don't know what the company does. Just say, no, the company has a good brand name. I have seen my friend investing in that company and he has grown. This is also obviously if you give money, which chart guy will you give a money at a higher rate? Higher rate means if you want good returns, obviously you will find a good return. But will you expect a high return from this company or this company? I mean, the high return as in if you give money discount, you know, how much return will you expect? Would it be around 12? Let's keep a range. 12 to 15. One company, let us say 12 to 15. Asking, and I'm giving a range of 15 to 17. How much percent return will you expect from a good company? Is it a range of 12 to 15 or 15 to 17? Obviously more than 12 because it is a private company. Obviously more than that, how much more? So obviously it will be 15 and 17. Why? Because the risk of losing business over here is quite lower than the one who is losing. So obviously when you invest in chart 2, you will want a more return because this company is very risky. Now when he says that, you know, I will earn 1,50,000, you will want I don't want 12%, I will at least want 17% return from your companies. And if you earning this much, I will only give you 80,000. So I have the safe, you know, I am safer. That margin of safety, I have that safety that I can only lose 80,000. I am not in a position to lose 1 lakh because you are a very risky company. If you are saying that you will make two, see, even if the company is risky, but they can still have an assumption, right? Still, this will have an assumption that it will grow, but you are not sure that this will grow. Why? Because of this all things. You know that cost of equity is this only. Now let us go to that CAPM formula. You guys say CAPM, CAPM. What is that? Capital Asset Pricing Model. If I say this now, every finance guy or every one CA guy or IPC guy, everyone knows this. Capital Asset Pricing Model. Sir, I know. They also know the formula, which is by heart. They don't know the meaning of that. So the formula, risk-free rate. What is the formula? Risk-free rate plus beta risk premium. First, I said if you want to, you have a money. Risk-free rate is not the FD rate. Okay, FD rate or Government of India rates. Okay, Government of India gives around 6%. Okay, return. Fine. The Government of India bond is the safest bond. Okay, in India it gives around 6% return. No. See, we are here calculate. So see, when you say that you have more return, so can I say more return means your cash flow will be higher at the end? What you will focus? You will not focus 150. You might focus 180 or 200. Right? That is the more expected when you earn. Okay, means obviously it comes with profits only, with sales and profit. Where is this cash flow coming? But free cash flow is coming from profits only. That is more return means this is growing. But not at what cost? What is the return? If you say that, see, this much growth is higher, you cannot give him at 20%. No? Here you said, why you gave 9%? Why this bank is giving 9%? Because they know that there's a risk for this bank. But you know that for ICICI, there's no risk. They can easily do it. So whenever the risk is high, you pay higher. I mean, you require higher returns. Whenever risk is low, you require low returns. And to increase the return, obviously this should increase them. Risk-free rate is 6%. You know, if I tell you market return, okay, market return means Nifty return, okay. Nifty gives 12% return in India. We'll take it 5, okay, as of now. Okay. If I tell you guys, don't invest in risk-free rate, invest in Nifty. Okay. Here, how much percent risk are you taking? If I tell you that Don't invest in FD. Don't invest in Government of India bonds. Invest in Nifty. What is the risk that you are taking to invest? Additional risk. Means if I, let's say, if I am a financial advisor, what you will say that Rishabh sir, I want at least 5% return, right? And Nifty gives 15%, that is 12% is fine. And what are you saying that invest in Nifty by taking how much risk? Market, that is your market risk premium. How much is it? 7%. So guys, you tell me that Rishabh sir, you are saying that I should take a 7% return, a 7% risk to invest in stock, 7% more risk to invest in stock market than in FD, than in your government of bond. So as a financial advisor, okay, how much return will you expect overall? How much return will you expect? Can I say 5 is minimum that you want? When you invest in companies which are other than FDs, can I say 5% is minimum return you want? How much more? How much risk are you able to take? I mean, how much risk the company is taking? Oh, sorry, not you. How much risk are you taking to invest in equity and not in Nifty? Sorry, not in government of bond. 7%. So 5%. You say that Rishabh sir, I too want 5% on my this on my equity investment. But now additional, I am ready to take 7% of risk. When I say total, it should be 12%. Means on your money, can I say you at least want 12% return? Let's say you are giving me the money to run my company. So what you say that 12%, 5%, so I get in FD. Obviously, I will want up and above 5%. Now, how much above 5% is 7%? Because that is a risk premium that you want to invest. Now, when I talk about, this is market return, okay? When I talk about company, I talk about beta. Let's say beta of 2 means, let us say more risk, okay? Beta of 1 means same risk as stock market, okay? Means what? Whenever I say beta of the company is a beta of 1, means what? My company is as risky as Nifty. So how much return will I want? How much return will you expect? If I say my company is as risky as Nifty. If you give me the money, and if I ask you money from you, how much return will you expect? Same as market, because I'm saying my company is as risky as the stock market. So obviously, if stock market is giving 12%, I will also get 12%. But how did I find this? Is 5% what I want, and 7% is the additional risk I'm taking. But if I say my company is more risky than Nifty, what will be now? If I say my company is more risky than Nifty, your return should increase or decrease? Means you will require more returns or less returns? Higher? Now, how much higher is that? You multiply this, the whole number. Sorry, you multiply the risk. What was the risk that is taken? 7%. 1.5 multiplied by the risk. See, when I do this, it becomes higher than 12%. What you multiply, this is the risk premium and beta that you multiply with each other to get a cost of equity. Means if as an investor, if you want to give me money, you will at least expect a 15% return on my cash flows. You will discount my cash flows by 15%. What if I say my company is less riskier than Nifty? And let's say I'm a Reliance, or I'm a TCS, I'm a Maruti, which are, even in Nifty, there are many companies which are risky, like Tata Steel, Tata Motors. Those are loss-making companies and risky cyclical companies. But there are also big large cap companies. What will be their beta? Higher, lower than 1 or higher than 1? Lower than 1. So if it's lower than 1, what will be, how much return will you expect? How much return will you expect? More than 12 or less than 12? Obviously less than 12. See, if I do it, let's say I do 0.5, see the return becomes lower than Nifty. Because here you understand that, no? Or from my perspective, if I'm making a model of my company, I will say that I will get money at 8.5% from you because what my company is less riskier than my Nifty. Now, obviously, this is not the case. It is usually more than, for smaller companies, it is more than the. So beta, again, how will you compare beta of two companies? Yeah, I will tell you, Prashant. How to compare company? How do companies? The beta is called the risk. And how do you define risk? How do you define risk? What are the risks the company has? This all. This all risk. The major risk in beta is also your debt. If the company one has a higher debt than the other company, which company is risky? The one company with debt or without debt? Company with debt. So obviously, what will be its beta? Higher or lower? Beta will be higher. Beta is usually, obviously this risk also comes majorly if the two companies are same. The major risk comes with the debt. If two companies have a higher debt on the other companies, obviously its beta will be higher. Now beta, I will tell you how to calculate for listed companies. Unlisted companies, there's a different method of calculating beta. Now that is a part of CFA level 2 curriculum, that how you find beta. Now, beta is nothing but volatility of the, now then come that volatility and all. Why? The volatility of the stock market, which is said to be beta. Now what is that volatility? Now it is said as Nifty return. See, how do you calculate beta for a company? The Nifty return. Yeah, in Excel it is very easy to find. Yeah, how to calculate it. Okay. I'm just giving you a few examples. Okay. This were the prices. Okay. I'm not giving the exact date. Okay. I'm just taking 7 days. You have to take it for at least 5 years. Now what I'm saying that today Nifty was 18,000. Okay. It became 18,100 next day. Historical, these are historical numbers. Let us say today 10 December. Now, so let us say this was starting from 1st December. Okay. 3rd December it was 17,900. 4th December it was something 17,999. Okay. Then it was 17,000. Then it was 18,150. Okay. 18,200 and then 18,000. So what is the return? Can you find the returns for company? Daily returns. How will you find? No, daily return. This was December 1. Second December. I'm saying the price. What is the change from December 1 to December 2? December 1. How will you find? It will be 18,100 divided by 18. Oh no, in percentage, Bishop. Minus 1. Ending value minus beginning value minus 1. This was the change of the Nifty. Now you calculate year, not year. This is the return that you found. That Nifty was up 0.56% on December 2. It was down 1.1%. Right now, your daily return that you will get. You will get this answer. I mean, you will get this on Google. Now let us compare with Hero MotoCorp. Same on December 1, let us say Hero MotoCorp was 2,500. Okay. Next date became 2,700. Third date became 2,600. Then 2,500. Then it became again 2,650. Then 2,700. And then it went to 2,600. 2,550. Again same. What was the return on day 2? After this, found the daily returns. First, you find daily returns for Nifty, daily returns for Hero MotoCorp. And what we compare is something called slope. Now, what does this beta of 1 mean? Ideally, if Nifty is up 1%, now beta of 1 means what? If Nifty is up 1%, my stock will also be, let's say Hero will also be up 1% when the beta is 1. Yeah, direct and proportional. When the Nifty is down 1%, Hero will also be down 1%. When you say the beta is 1, okay, and the beta is 1, what does it mean? That if Hero, okay, if I say beta is 1.2, then what does it mean? I should give Nifty as a base common. If Nifty is up 1%, then Hero will be up how much? 1.2%. And what if the Nifty is down 1%? What will be the beta for Hero? Sorry, what will be Hero? Nifty will be down 1.2%. So this is how it works. Okay, Nifty and beta. What if the beta is 2? Again, if Nifty is up 1%, how much will be Hero? Finally, Ajit is replying one or other. 2% and same way the beta. And which is risky? Beta of 1 is risky or 2 is risky? Because 2 is risky because see, even if the returns are higher, but the loss is also higher over here. Returns are higher, the losses are also higher over here. So next, as I said, beta means the risk. So higher the risk, it is not good for the company. Now this is what I found. Now this was just I gave an example of the relationship. Now I found a relationship with this. What is the relationship of this and this? If Nifty is up 1%, what is the price of Hero MotoCorp? So how I found a daily return for Nifty, same day. Daily return for Nifty, daily return for MotoCorp, and then there's a function in Excel called is equal to slope. You can write this if you want. Slope. When you take slope, what is it? What does it say is that know your whys. Know your whys means the company. Means what is the returns of your company? See what I'm doing, I'm just tracking it. And return and know your X. Know your X over here means the Nifty, which whatever you are comparing with. Now here what I got, beta of 4. What does it mean? Yeah, the benchmark will be the second rate, that is X. The benchmark will be second and your company will be first. Okay. So this was quite, so now this is, yeah, when it was 4, it was quite risky because see, ideally you can see the fluctuation. You see, Nifty was only up 1%, the stock was up 8%. Whereas when Nifty was up 0.5%, it was down 3.8%. So it was, quite risky stuff. Up 1%, up 6%. So it was very high. So I know this won't happen like this. Since Hero is a good company, I will keep like this. This is the way you find the beta. Now this you will take it for, you cannot take it only for 7 days, you have to take it for at least 5 years daily return. 5 years daily return. You can also find the beta on money control if you want to do it quickly. And always compare your beta with the money control. You will get an approx number. Hero MotoCorp. It will get updated over here. Once it gets loaded, it will come. So you can find this way, or maybe. Now what will happen if it's 1.5? What will happen to my cost of equity? Increase or decrease? If my beta was 1.5, will increase my cost or decrease? My company is much more riskier. For Hero, the beta is 0.89. Now I do it 0.89. Obviously, my cost of equity decrease. Okay. And obviously, my WACC will change. The cost of equity I have to just link this cost of equity with over here. Achha, my cost of equity was 15. Okay, that is what I've assumed, and I found a value of 46 or this one, 2332. Now I change my cost of equity decreased to 11.2. How will it impact my valuation? How will it impact my valuation? I found the value, it was 2322. The value will increase or decrease? Enterprise value will decrease. Previously, the cost was 15. Now the cost of raising the capital is 11. So it is good or bad? Is it good that your cost is decreasing, or is it bad? And your cost is decreasing, right? It's a good sign. Now you will value the company at a higher rate, because now when your cost decreases, what does it mean? That your company is less risky now. Okay, the value will increase. See, as you go to DCF, your value will increase. Now 3, 4. Now we got an upside of 25%. Okay. This is how the valuation is done, and this is how the CAPM, WACC. You know, with this model, everything is linked to each other. If you are able to know this model, everything is linked to each other. Now, practical question: if my days of receivables increase, means it is taking me more time to get my money back. What will happen to my valuation? Increase or decrease? Why? Probably this is practical. If it's taking more days, but see how it works on Excel. I do it 50. What was our value now? Upside of 25%. Okay, 3452. Now I'm saying that it is taking me more time to receive my money. It's taking me 50 days to receive my money. Obviously, it is not a good thing. So obviously now you will not pay a higher price, you will pay a lower price for the company. And obviously it comes to 3180. Many things are linked to each other. Most important, which is expected to ask in an interview, is from your asset schedule. What if your depreciation rate changes from 6 to 10%? It changes to 10%. What will happen? I mean, what will happen to your valuation? Will it increase or will it decrease? Value increase. Why? I would value increase. Because I have told you this in the first or second class, or maybe because depreciation increase leads to increase in your cash flows, because depreciation is a non-cash expense. Though it's an expense, but it reduces your taxes, and taxes is your operating cash flows. You know, expense increase, but ideally you don't pay money to anyone. Just the rate has increased. You have already paid that in the capex, so you don't pay this to anyone. Increase in non-cash expenses actually decreases your taxes. That taxes will increase your reduction in taxes will increase your free cash flow to firm, and then your value will increase. It increased to 3561. See, many things have changed on your model. Okay, see what all things change. With just one change, depreciation for the year change, net fixed asset change, cash flow change, P&L change, profit and loss change, taxes change, your free cash flow to firm then change. Obviously, your PAT change, depreciation change, capex change. No, capex will not do. Sorry. PAT change, depreciation change, asset change, liability change, other equity change, and then this whole thing impacts your. And still, you will see my balance sheet will still tally. They will not have any impact. They will not have any impact on my balance sheet. Now, this is when you say that you know the model perfectly inside out. Whatever change you give me, I know what will happen to my model. Now, majorly it starts from sales assumption. So, what if my tax rate decreases? 25 became 20. It decreases. What if my tax rate decreases from 25 becomes 20? What is my value? It is okay, to 3526. So revenue assumption is a big part. We're not discussing more here. It takes a lot of time to discuss how to predict project revenues and all. Ideally, if I want to give you a fresher's view, it is the industry growth rate. Okay. If historical is positive or negative, you have to Google it and find what is the industry it is growing. And let's say Hero MotoCorp. Hero MotoCorp works in two-wheelers. That is only 120 to 150 cc segment. So you should find that what is the growth in that segment. Rather than you can take it as a proxy for that. If historicals are positive and negative. First is historical, obviously. Second is if the historical is very positive and negative, you can look at the industry growth. And specifically, if you get an answer now, if it's not auto industry, because auto industry is very big, you should take specific, which product that company is into, which is their major product, and then take a growth rate. As I can just tell you, very fast. If I want to tell you fast how you calculate, this way you take the assumptions. Or else there's a big, many things to take into assumptions. That is not required for a fresher. Tax, ideally, tax decrease is a good sign, huh? Am I right? Now, whatever the calculation is, wherever the tax is linked, tax decrease is a good sign. You are paying less taxes. But now, what happens? When you pay less taxes, what happens to your cost of debt? What happens to your cost of debt? Increases or decreases? Now you're doing contradictory. You say the cost is increasing and still you say that your value is decreasing. How? How? Just now you said that when your cost increases, your value decreases. When I ask you, you decrease your tax rate, you said value increases. Which is right? Value increases or decreases? You only have two options. Someone will say increase, someone will say decrease. Why? Yeah, but tax decrease is also a good thing, na? Your cash flow will increase, right? It supersedes the cost. Yeah. But it supersedes. Yeah, this was the answer I expecting that See what happens when your tax rate decreases. Obviously, we say that cash flow from operation increases, your FCFF increases, but it is also increasing your cost, and that is the major factor that the whole FCFF is discounted on WACC. So your WACC will increase. Now, when will it increase? See, it can only increase when the debt portion in your capital structure is higher. If your debt is lower, it might not lead to that much of change. Am I right? Now, in our example, what was our debt? Our debt was 3367. So now, ideally, Hero didn't have any debt. Hero's debt was this much. If I take this much of debt, okay. So now I'm looking at my valuation. Now it is 3607. Okay. Now, if I change my tax rate, you said the value should decrease. Now, if I change my tax rate, see what happens. My value actually increased. You see why? My value actually increased because I didn't have any debt. That tax benefit wasn't of any use to me because my debt was hardly any debt. There was hardly any debt in my capital structure. See, my weight was 98 and 2%. So what will it will change my cost? Hardly it will change my cost. It was not even 2%, it's 1.8%. So the company who has a higher debt, okay, will have a higher benefit of taxes. Or let's say if the tax decreases, it is a bad thing for him if the tax decreases, because now he will lose on its all interest benefits on it. If I say 0.5, now see what happened. Now this was another example where 0.5 and I have taken my debt is 60/30, and here my value was 36% of the upside. No, sorry, 25 now. 25% was my upside. So ideally now just 29%. Now let me change my tax rate to 20%. Now what should happen? Value should increase or decrease? Now I've changed my debt portion. My debt is 33, almost 33, 34%. Now the value should decrease. Still increased. Increase now. What was it before? It was 39. Huh? 29. It still increased. You see? It still increased. My value still increased. Because this is still I am okay. I don't have that much of debt. If I would have had a debt of 1 point or something higher than equity, that time I would have said that decrease in tax rate will actually decrease my value. Okay, so that for those companies, decreasing tax rate is not useful only. See, ideally for when you talk about on a like-to-like basis or maybe any random companies, decrease in tax rate is said to be a good sign. Always. Because obviously it will save, na? Today, if Modi government reduces your tax on your income, you will feel unhappy. You will be unhappy. You'll be happy, right? You'll be happy once your tax is decreasing. The tax decreasing is actually a good sign. But the one who has higher debt will be a bad sign for them because they will be losing on its benefit, whatever they were getting. So I'm not saying that higher debt is good sign, but debt under a specific limit is said to be a good sign. Okay, so high debt companies, Tata Steel, Vedanta, Reliance Energies, R Power, Tata Power. If the tax rate decreases for these companies, the value actually will decrease because this company works on high debt and they save a lot of cash on the tax rate. They hardly pay any taxes. When Tesla don't pay taxes. Tesla is a loss-making company. You guys know? Tesla is a loss-making company. Who is the richest man on earth today? Elon Musk, the owner of a loss-making company. How? Are people mad to give Tesla so much of value? You know why? Because he is smart. You know, he has also said that he will not give his, he will not send his children to school, because school, he thinks it is doesn't give that much of value what he can teach to his kids. Yeah, Burner currently. If others don't know, he is the owner of Louis Vuitton brand. Now, how does that debt work? That interest, now 1 minus t, how does, you know, now I am Rishabh being a salaried and Rishabh being a freelancer. There's a lot of difference between this. You know how? Now, see, I'm not working anywhere. I work on freelance basis. Salary, if I would have earned 10 lakhs, the tax rate is 30%. Salary is 10 lakh, okay? Tax rate is 30%. When I say my tax expense would be 3 lakh, and what will be in my hand? I have salary in hand. This is what you get. I say my income is 10 lakh, but I only get 7 lakh in my bank account. Why? Because I'm just taking a random assumption that 30% is the tax. Okay. Fine. Now I am being a freelancer. I also earn 10 lakhs. Okay. So now here I have the liberty to take my expenses. See, now I'm teaching you. Okay. Let us say I'm getting money to teach you. Now, you know, in my income tax account, since it's a business, right? It is not a salaried job or something. It's a business. Now it's a B2C business. But I'm teaching you, giving services to you, and you're paying to me. So for services, you know, I required a laptop. I require internet connection. I require my light. Though I'm sitting at my home, okay. Even my parents are using the same light and same electricity and same internet. But still, I can claim those expenses as my expenses in this. Let us say those expenses were, example, let us say 3 lakh rupees, okay, for a year. Now, what is my profit? This is not called my salary. It will call me as sales, my revenue. My expense 3 lakh. Now, my GST comes after a particular. That is all included in sales, huh? GST I collect, I will collect from you and pay. Here my profit is okay, 7 lakhs. Now I will pay tax on the 7 lakhs. Now let us assume I take an interest. I have 10 lakh rupees in my bank account. Okay. Let us say it is all after expenses and all. Now, if I want to buy a car, so if you buy a car, if as a salaried person, if you buy a car on interest, on obviously on loan. So if I say that you have taken a loan of, let us say 10 lakh and you pay 1 lakh rupees EMI, will that reduce your tax? I will say I will not earning 10 lakh, I am earning 1 lakh. Does you have the liberty to do that? For a salaried person, it is not. Oh no, for me today, even if I have 10 lakh in my bank account, I will not go and buy a car on this 10 lakhs. You know what I will do? I will invest this 10 lakhs, let us say in the stock market. Okay. I will invest this 10 lakh in the stock market and will, let us say that will give me a return of, let's say 15%. Okay. Example. After 1 year, the value will be this. So let us say I took a 5-year loan. Okay. So my value will be invest for 5 years. So my value will be 2 lakh. Okay. After 5 years, I will take a loan of 10 lakhs. Take a loan of 10 lakhs. And let us say 7%. The interest is around 7 to 8% in India. I am paying how much? 70,000. I will charge over here my interest. See, if this was my profit, let us say this was my profit, I would have paid 30% tax. That is 3 lakh I would have paid. Now what I do is, I don't say this is my profit. What I say, I add my interest expense. I can do this because I'm using it for business purpose. I will take this 70,000. Okay. I will take this as 70,000. Now you know what will be my interest? Previously it was 3 lakh. How much will I save? How much will I save now? My tax. And how much tax will I save? I've told you how to do this. Interest expense, what do you do? How much tax you save? Previously I was paying 3 lakh. Now I will not pay on this 1 lakh, 10 lakh. I will pay on this 9 lakh. Can I say ideally 70,000 is the interest? So 70,000 into 1 minus T. 21,000 I will save. No, I was paying 3 lakh. Now I'm saying how much? Only 2 lakh 71,000. 21,000 rupees I saved. Okay, over here. Just because I've taken a loan. What I have done, I have invested in the stock market. Even if for 1 year, how much return I earned? I earned 1 lakh rupee. Let us say on a tax basis, I would have earned after tax basis. Let's say I would have earned after tax. I would have earned 4,50,000. Means I earned rupees 4,50,000 by investing that money. Okay, after tax. I am saying after tax. I saved 21,000 on interest. I earned with how much? 4,50,000 and 21,000. So ideally, you know, this was my income. This is the amount that was up and above. You tell me, does it make sense to invest this 10 lakh into this car where I will not get this benefit, nor even this amount? What to do? Huh? What is more sensible to do? What is more sensible to do? Should I take my money, the 10 lakh rupees which I have, and invest? Take a car, which obviously I will use it for business purpose, but that is a different thing. You know how much money I saved over here? Ideally, 10 lakh rupees car didn't cost me only anything. This 10 lakh, how much I will pay? I will pay 10% extra additional. For 5 years, I might pay, 1,40,000, but how much I'm earning over here? If I do this 5 years, I am earning so much. So ideally, my car was, loan free. How much I earned? 13 lakhs. What was my loan? 10 lakhs. And 10 lakhs plus even 70,000 you do is still less. Still I'm saving taxes. That is a different thing. So 21,000 example, I will save it for next 5 years. Means 1 lakh I saved in taxes. I got a return on this. So 10 lakhs I will pay off. Let us say 70,000. How much the interest I pay for 5 years? I will pay 35,000 plus the 10 lakhs. This is how I will pay. This is what I saved. Now virtually my, this was almost tax free. I mean, my car was almost free of cost to me, but I actually saved 1,43,000 on this. 13 lakh I earned this. Okay, 3,50,000 I paid. So okay, I had a loss over here. But you know how much I saved? 1,05,000 I saved over here in my taxes. this is the profit that I actually made. 1,43,000 is what I have saved by doing this kind of thing. Now see, this is looks as a small amount. What if it was 1 crore, 10 crores and 100 crores? You know how much I would have saved? This is how the interest rate works. And that is why now higher the interest, better for the company. Obviously, now debt shouldn't be more than what you have. It should be in a prescribed limit. But this is how big people make money. That is why you see Adani taking loans, Reliance taking loans, Godrej taking loans. Every one company, the one Elon Musk takes billions of loans. He doesn't pay taxes. He takes so much of loan that his profit becomes zero. He takes so much of loan. He doesn't pay taxes only. Though he has a lot of money with him, he never uses his own money. Save taxes, and you know, in US the taxes is 50%. And this is now if you be in Mumbai and if you are a Gujarati, you know all those things. This is how they make money. Yeah, government bonded is only used in capital. GOI, Government of India rate. This is how the interest rate works. Okay. So yeah, someone had asked me about the beta for non-listed companies. Now what happens? There are two things over here. If the company is unlisted, what you do is you take a comparison of the listed peer. Okay, whatever it is listed, the beta should be equal to that company. Now what happens? You know, it is okay if you find a peer. What if you don't find a peer? What if there is no comparison or no company who is a competitor which is today in the market? You know, like previously Zomato, when it was not listed, did Zomato have any competition which is a listed one? Even Ease My Trip. Ease My Trip and Make My Trips are competitors, but Make My Trips is not listed. Ease My Trip is listed. So how will you compare? There is a previously both were not listed. So now in this scenario, what is done is you just keep on adding premiums to this. How much here you only added market risk premium, right? Then you will add is that whether the company is small or big, okay? Whether the company has debt or not, okay? Less debt, more debt, more debt, less debt. Okay, means if it's more debt, you add up more premium. So now this is all defined. Practically, you should think about how much return you expect from a company. If the company has a debt, if the company is small, if the company has economic issues with it, all those now are added over here. Those are called risk premium, big and small risk premium, more debt, less debt, industry risk premium, product risk premium. All these are added to it. Now there's no fixed method of doing it. You just keep on adding premium. I say that since this company is small, I want 5% premium. When the company has more debt, I want 2% premium on that. So your cost of equity will start increasing with this whole thing. So 11 plus 5 plus 2. It keeps on increasing. Levered and unlevered beta is a different concept. I will not tell it over here. It is a different one. Okay. But two things. Okay. First is you should compare it with the listed peer. If the listed, the unlevered and levered is there, it's a concept which is there into books. I will not do it right now because it will take time. Second thing is you take all those discount, all those premium for the riskness of the company. This is all a part of CFA level 2 books. If you go and see in this book, you find all this. What is how to take unlevered beta, or how to take for companies beta for private companies and all those stuff. So that time there will be no beta. Okay, there will be only be risk premiums. So keep on adding risk premiums. So ideally it is the size premium. Okay, this is called the size premium. This is called the size premium, and this is called the that what do you say liquidity premium. Is the company liquidity premium? Is the company able to pay? These are the majorly premiums which are used. Now there is no criteria for defining any such things. It is just see what you expect, how much risk you feel. This is ideal. Cost of equity will be 12%, 11.2%. But after that, if the company is small, how much will you expect? How much return you expect? Now this is all on an analyst to analyst perspective. But this is what you keep on adding it. As you said, now you said that you want return more than 12%. So how much more? You said 15. So why 15? So you keep on adding, let's say 2, 3, whatever, depending on what you feel it is. These are just, when you go into this field, that time you'll understand. But for interview purpose, you can say this kind of things. Okay. Right. This is a part of CFA only, so it is written somewhere. This is how decided, that is dependent on your analysis. What you know, how much company you have seen, what premium they get, etc., etc. Okay. So our DCF ends over here. Okay, now in Excel, there was one thing I would like to tell you in just 5 minutes. Since something is called sensitivity analysis. Now, what is that sensitivity analysis? Is what if my here, see, my major inputs were WACC and growth rate for FCFF, major input, because growth rate changes my full terminal value and WACC changes my whole value. This was my major input. What if the VAT and growth rate changed permanently? So when will your WACC increase? When will a WACC increase? What was the reason when the WACC increases? Guys, tell me. WACC means cost. Increase. When will a WACC increase? Okay, interest rate increases, fine. Cost of debt increases. Why would a cost of debt? Okay, economy is fine, but this is company specific, no? Why will the interest rate of a company increase suddenly? What might be the reason? What might be the reason? Higher debt taken, right? Higher debt taken, yes. Tax rate increase, yeah. Can happen. Can I say beta increase? Beta increase means obviously the products company is making lower cash flows now. Company products are not good. Company's margins have declined. All those risks, all those is related to your business and operation risk. Now, what if it changes? So how will it look? Now, every time you cannot change a number over here and see. Now, what we do is, your market premium changes, right? Can happen. All those interest rate overall in the economy increase, that can also lead. But we are still talking about company specific, so we'll talk about risk. The company might have taken higher debt at a higher rate. Now, this is how I create. So this is a sensitivity table. See what I've written. I've just taken numbers, which is like 11% was my average, right? So it was not 11, it was actually 11.30. So I've taken 11.3. You just put this number, whatever it is. How do you know? Copy and paste special and then paste values. Then the number will come like this. Because there's a reason why I'm doing it. Because when I do this sensitivity analysis, what I'm assuming that what will be my value, this value, if my growth rate is 3% and my WACC is, this is how it works. This is all WACC. This is all growth. This is usually used, asked in interviews. Listen to carefully. What if my growth rate is 3 and my WACC is 13? What will be my price over here? So I will get a price over here. What if my growth rate is 5 and my WACC is 11.3? So I will find a price over here. So this is all get into this analysis. So what I do is first I put this, let's say 2% down, 2% up. Here also 2% down, 2% up. So 10, 11, and make sure you put this number because to tally it. What I do is equal to, I link this. I link my value per share. This is coming from linkages, the value per share. I select the entire column. I go to data, what if analysis. What I do is first thing, I just put this number. Okay, random number you can put is equal to link this, enter, select the entire table, go to data, what if analysis, data table. Now row input. Now guys, in this, which is row and which is column? This is rows and this is column. When this is growth is in column or WACC is in the column, in the row, sorry. WACC is in the row because these are rows, okay? WACC is in the column, na? It is in the column. Rows is this. Where is it? In row it is growth. Rather than WACC, it is in column. Okay. WACC is in column and growth is in row. Now this is row, right? This is a row. This is a row and this is a column. They are estimating that what is the row input. Now input is what? Not this answer. Input is where we have put our formula, where the formulas were all linked. So row input, we know it is growth, and column input, what is that? It is our WACC. That we are estimating, not this answer, okay? Not this. You can look at the videos again of this. Row input is over here, from where we have formulated the numbers. And again, WACC input, column input is the WACC. So WACC is this over here. And I press OK. So when I press OK, I get all these numbers there. What was R? It was 3755. No? So it was what? Our assumption was 11%, 11.33% WACC, and our 6% growth. It is coming. This answer comes, matches. Now, if I do 7%, now if I change the growth to 7% and my WACC is same, my answer will come 448. See over here. If I do 7%, my answer will be what? 448. See? This is called your sensitivity analysis. Advanced Excel skills, okay? Not sometime it is required. Okay. Okay, great. Yes, orders then get okay. Advanced Excel skill, then you can use this in your analysis. Okay, so sensitivity analysis. This is how you do it. Sensitivity analysis. Okay, fine. This was our last day of the class for financial modeling. So you try making models. You know, you can always connect me on LinkedIn. My ID is, many of you have contacted me. I'm writing my ID. You know, Rishabh Kade. You can just type Crizzle, or you can just type Wellinger. You know, comma Crizzle, or you can just type Wellinger. So that I teach. You know, Rishabh Kade, comma Wellinger. You might find me there on the LinkedIn. You can connect. I keep on posting jobs. I keep on. I have my connects. You know, industry connects who at times require interns or maybe some. If you have experience, you know, they require experienced candidates at times. So keep on posting it on LinkedIn. You can connect me if it's relevant for your field. You can always apply, or just connect to me that, you know, sir, I need to apply. Can you connect with me, the interviewer? So if he's my friend, I might help you connect with him as well. Okay, but first do something that, you know, I will refer you. Not just because we are in the class, I will refer you. See, but because I'm not hiring, see. So obviously, even if I refer you, your CV will be rejected. But whatever they want, you should know it. So there are recruiters, okay, even in equity research, you know, they say that Rishabh sir, you are since teaching in colleges and all. Do you think that any candidate is there over here who is smart enough that, you know, can at least know modeling, who can enter as a fresher? Yeah, you can do it. You can do it, and you can send me the models on, you know, on my mail ID. I'm sharing my mail ID. I'm sharing you my email ID. If you have a model, you can just I will reply on your email. Because there are students, past students who make models and tell me that, sir, this is how I've made. Tell me the mistakes. So whenever I get time, I do that. Okay. Thank you, guys. Thank you. Okay, I'm sharing this file. I'll share this file with Soumitra as well. I'm sharing you over here as well. Thank you. All the best for your career. We might connect on LinkedIn. And I think this is really our last interaction, at least for EP Valley. So all the best for your career. I hope I was able to teach you things which are helpful in practical as well as your personal life. Okay. See you.